I think we're going to have another big week in the precious metals. I'm still looking for silver, which again is around 38 and a half, 38.40. We got above 39 a couple of weeks ago. Once we get above 40, I think we're going to make a beeline. The 50 might be a little bit of resistance, but once we break through it, I think we could be closer to $100 an ounce than 50 on silver in short order. The dollar is going to be losing value much faster in the future than it has in the past. In fact, I think it's going to be exponential how much value and how quickly the dollar is going to lose it. So that means you're going to need more and more dollars. You'll need $5,000. You'll need $10,000. You'll need $20,000 to buy an ounce of gold. And again, gold is not getting more expensive. The dollar is getting less valuable.
Silver followed gold's lead this week. Prices dipped slightly on improved risk sentiment, but the metal is still holding firm thanks to the same macro drivers propping up gold. Dovish signals from the Fed and ongoing uncertainty in global trade talks. Peter Schiff points out that silver recently broke above $39. He says once we clear $40, the jump to $50 could come fast. Yes, $50 might slow things down a bit, but a clean breakout could set silver on course for $100 an ounce. Gold and silver are caught in a tug-of-war, strong risk appetite pulling one way, and persistent geopolitical and economic uncertainties pulling the other. Schiff also warns that as the dollar weakens more quickly, it'll take more of them to buy the same ounce of gold. $5,000, $10,000, maybe even $20,000. That doesn't mean gold is suddenly worth more. It just means the dollar is worth less. Paper and digital money are recent inventions, and for most of history, gold was the standard. Voltaire said it best: fiat currency always eventually returns to its intrinsic value, zero. Gold's value, on the other hand, comes down to its weight. This week, gold's small gain was overshadowed by silver's 4% rise, and by the performance of mining stocks. The GDX and GDXJ hit multi-year highs, even though gold itself didn't have a blockbuster week. That's a strong signal institutions may finally be moving into the sector. Here's the kicker: GDX is now on record high watch. It's already outperforming gold this summer, and it's within striking distance of its all-time peak from 14 years ago. If that record falls, it could set off a wave of bullish sentiment in the market. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
We didn't see record highs in the spot market. And the reason for that was that Donald Trump threw a monkey wrench into the gold market because there were stories that came out that 100-ounce and kilo gold bars would actually be subject to tariffs. And a lot of those bars are fabricated in Switzerland. And Switzerland is subject to a 39% tariff. At least Americans are subject to that tariff if they import something from Switzerland. Well, if you import gold bars from Switzerland, 39%, that is a huge premium. And so what happened was, I think some of the shorts in the futures market needed to cover. They needed to buy back their contract, because when you are short a contract, you are obligated to deliver the underlying metal if the long decides to put in a notice that he wants delivery. Now, of course, most of the gold that trades on the COMEX is never delivered, so it's not a big deal. But anybody who is long one gold contract could take delivery of a 100-ounce bar. And that means that whoever is short could get assigned that delivery. And it means that the short, if they haven't closed out their position, now has to buy a 100-ounce bar and deliver it. Well, if you have to import that bar, you have to pay the tariff. You can't charge the tariff to the long because he's got his price locked in. As a short, you are obligated to deliver gold at whatever price the long owns. He just has to pay the price that he paid when he bought the contract. And the short has to deliver the gold at the price he sold the contract, but now he's got to pay a tariff. And even if he wasn't going to have to import the bar from Switzerland, you would figure that all 100-ounce bars or kilo bars would start to move up in price because it was so much more expensive to bring them into the country. So I think in the futures market, you got a lot of short covering, which is what spiked the price to record highs, without seeing that in the spot market. Now, I believe the spot market would have followed and made new highs probably this week, although it could do it. I mean, gold closed around 3,400. It's never hit 3,500. I forget what the record high was, maybe 3,450-ish or something like that. But what happened after the markets closed on Friday is the Trump administration backtracked, although they said it was all misinformation and that Donald Trump is going to be issuing an executive order that clarifies the fact that these gold bars are not going to be subject to the tariffs. But, I don't really think it was misinformation. It might have been a trial balloon that didn't go well. And maybe, after Trump was presented with some facts that he didn't like, he changed his mind and decided to say the whole thing was misinformation. But I doubt the stories would have run had the government not put out that information. They just didn't like the way the markets received the information, so they did an about face, which is something that is pretty typical of the Trump administration. I just wish they would do an about face on more things. I'm going to get into that in a bit, but the Trump administration is doing a lot of things that I think are wrong and unconstitutional and bad economics and should not be done. But let me get back to what's happening in the gold market, or the gold stock market. So gold was up 1.3%. I mean, not a huge week. Silver was up more. It was up about 4%. But that's because silver was down 3% the prior week. So silver just kind of bounced back, recovered ground that it shouldn't have lost. But the real action was in the mining stocks. The GDX, which is an index of gold stocks, the GDX was up 10.7% on the week. That is a big move. The GDXJ, which is the juniors, was up 11%. And in fact, it took until Friday, I think, for the GDXJ to make a new, 52-week high or a new high since, 10 years, 12 years, whatever. But the GDX made a new high for this particular bull market, I think Monday or Tuesday. It took a while for the smaller stocks to catch up and eventually make new highs on Friday. But I think the fact that you're finally starting to see significant strength in the gold and silver mining companies, even without a lot of strength in gold. Gold did not have a big week, but the mining stocks had a huge week. And so I think this is really a sign that institutional money is finally waking up to what's going on here and allocating money into this sector. And we got a long way to go. I mean, these stocks are still substantially below their highs from 2011 when gold was at 1900. So, I mean, gold has moved up 80% since then. And, a lot of these stocks are, quite a bit lower now than they were then. And the valuations are ridiculously low. If you look at these stocks on a price to earnings ratio and a lot of other metrics that historically you use to value these stocks, and these stocks are at historically low valuations. And so I think this is not going to be lost on investors for long. You're going to see more and more money flowing into these stocks, and I think the returns are just going to get better over the years. Now, the GDX is up now after this 10% move. It is up 71% so far this year. Of course, the year's not even over yet, and you got a 71% gain, right? Investors, institutional investors, are going to notice this. They're going to start putting gold stocks on their screens, I think, for the first time. For all the hoopla around Bitcoin, right? Because Bitcoin's stole all the spotlight from gold this year, right? Everybody, Bitcoin, right? With the Trump making America the Bitcoin capital of the world. Meanwhile, he's adorning the entire Oval Office in gold. I mean, I saw some images of the Oval Office now, and there's just gold all over the place. In fact, I saw that Apple, Tim Cook came to the White House and presented Donald Trump with like a token of his appreciation, a plaque, a glass plaque. But the case, right, or the base of the plaque, he said was 24 karat gold. Now, if it's solid 24 karat gold, that's $1 million base. That's a great gift for the president, kind of, more like a bribe, because he was giving out some exemptions on tariffs on semiconductor imports. But Bitcoin has been getting all the attention. Well, Bitcoin is up on the year, but 24%. I mean, that's still a big move, although Bitcoin can crash, at any moment. But it's up 24%. But if you bought gold, gold is up 29% on the year. So gold year to date in the year of Bitcoin, and gold is beating Bitcoin. And, with all this buying, and, a lot of the buying now is coming from these Bitcoin treasury companies. Now they even got Ethereum treasury companies, but it's all Wall Street piling into Bitcoin, yet it's not even doing as well as gold, but it's doing a lot less than the gold mining stocks. Because you would think, hey, let me leverage a bet on gold. Maybe somebody thought that Bitcoin was a way to leverage gold, that they thought it was, supercharged gold 2.0. Well, it underperformed gold. What outperformed gold were gold stocks at 71%. Gold stocks even outperform MicroStrategy, which MicroStrategy stock or strategy, and they dropped the micro, although pretty soon it's just going to be micro because the stock's going to collapse. But year to date, it's up 38%, although the main reason for that is that it got clobbered in December. From the end of November, it's basically flat. But year to date, just for apples to apples, MicroStrategy is up 38%. You've done a lot better buying the GDX, gold stocks. And I think this is going to continue. And I think that a lot of people who took some of their gold chips and moved them over into the Bitcoin space, they're gonna move them back. They're going to realize that they're better off with real gold rather than this digital alternative, fool's gold. And that money is going to come back to the gold market. I don't even think it's started yet. I just think you have some new money coming into the space, but the money that left it hasn't come back yet.
Peter Schiff's point boils down to two major shifts. First, central banks are cutting their reliance on the US dollar and building gold reserves instead. This de-dollarization trend is structural, not temporary, and Trump's policies could accelerate it. Gold may be dismissed by some because it doesn't pay interest, but that misses the bigger picture. Since 2000, it's averaged about 8% annual gains and is now pushing to new records. With inflation running hot, currencies weakening, and global crises multiplying, that move higher could just be starting. Part of the reason it's underrepresented in traditional finance is that it doesn't generate commissions or management fees for banks, and it's rarely marketed as a savings vehicle the way stocks or bank accounts are. Second, capital isn't just leaving the dollar, it's leaving US markets altogether. Since around 2013 to 2014, global investment flows have been heavily skewed toward US equities, leaving the rest of the world's markets underfunded. That cycle is now reversing. Money is moving out of an overvalued US stock market and into better-priced foreign markets, where long-term return potential looks far stronger. Let's get back to the interview.
What's going on here is a major rotation, and it's actually a double rotation. There's a rotation out of dollars into gold. Central banks are moving away from dollars as their main reserve asset into gold. And this trend, I believe, is going to continue for many, many years. This de-dollarization trend is here to stay. And what Donald Trump is doing is going to accelerate the move out of US dollars. But it's not just out of US dollars and out of US bonds, it's out of US stocks. The world has been over allocating into the US stock market for more than a decade. Ever since really around 2013 or 14, around there, it's just been, all the money has been moved into the US at the expense of the rest of the world. So the rest of the world is really stagnated as the US stock market bubble inflated. What's happening now is the air is coming out. Money is being sucked out of overpriced US stocks, and it's being reallocated into much better valued foreign stocks. That's why you're looking at a 33.7% return on my foreign dividend payer fund. And I think, again, this is the beginning, not the end of this move, that it's not just going to continue for the balance of the year, but for the balance of the decade and into the next. So you really want to have your stock market money that isn't in gold stocks, in international stocks, and you want to get out of U.S. stocks. Again, the symbol on my dividend payer fund is EPDIX. And, even my international bond fund, EPBIX, right, my foreign bond fund, is up 10% this year. 10%, that beats the S&P. So without taking any stock market risk, just holding a portfolio of foreign bonds, you're up 10% on the year. Compare that to U.S. bonds. Look at TLT, which is a closed-end U.S. bond fund. It's probably the most popular closed-end U.S. bond fund. It is flat. You have zero return. So if you bought U.S. Treasuries on December 31st, year to date, you've made no money. But if you just bought my foreign bond fund, year to date, you're up 10%, right? So that even beats U.S. stocks. I mean, it crushes U.S. bonds. So this is showing you what is going on, right? Most Americans are asleep. They have no idea that this transition is even taking place. They will probably, if not next year, the following year, maybe American retail investors will finally figure out what's going on and start to, move some of their U.S. assets into foreign stocks. But by then, of course, foreign stocks, I think, will be much higher relative to the U.S. stocks that they're selling. I think the sleeper is going to be the emerging markets. I have an emerging market fund, symbol is EPEIX, and that fund is up 17% on the year, well less than my dividend payer fund, because the emerging markets, I think, are still, being overlooked in what's going on. But I think they're going to be some of the biggest winners. So I think that fund and other emerging markets are going to kill it in 2026. Because that's the year I think the dollar is really going to come under pressure. I mean, this is a bad year for the dollar, but I think next year is going to be even worse because that's where I think a lot of these chickens come home to roost. We're going to see the full impact of the tariffs, of the return of inflation. The Fed is going to be cutting rates. The dollar is going to be tanking. We're going to be mired in stagflation. It's going to be obvious. I talked on my last podcast about how bad the jobs numbers are, especially following all the historic revisions that we've seen to those jobs numbers. We're going to get revisions, I think, to the GDP numbers. The economy is far weaker than has been, advertised and perceived, and inflation is stronger. So inflation is going up, the economy is going down. Things couldn't be worse, I think, for U.S. investments, but they couldn't be better for international investments and for gold investments. I wanted to talk about a couple of things that Trump's been doing. One of them just happened. I mean, just before I started to record this podcast, I read an article about Trump getting NVIDIA and Advanced Micro Devices to agree to pay the U.S. government 15% of their revenue selling their products into China, right? 15%. And I guess if they didn't agree to that, I guess Trump was going to say you can't even sell these products to China. And in theory, the reason that we would prohibit the sale of products to China was because of a national security risk. Well, clearly, if we're going to allow the sales to happen, but just force the companies to cut the U.S. government in for 15% of their sales, then clearly it's not a national security issue. Because if it was a national security issue, then we wouldn't allow them to do it at all. So to me, this is a backdoor export tax. We're basically telling these companies, we'll allow you to export these products, but you got to cut us in, with a big slice of your profits, which I think is unconstitutional on so many levels. First of all, it seems to me like it's extortion, that, Trump is shaking down these companies and getting them to agree to this, right? With threats, hey, we're not going to let you do this, but we will if you cut us in, right? Which they can't do. I mean, yes, there already is a tax, right? If NVIDIA, if AMD earns a profit, they already pay an income tax to the U.S. government. So the U.S. government already has a piece of the pie. But now they're demanding, or Trump is demanding and getting an even bigger piece. But he can't do that. Trump can't just levy taxes on NVIDIA or on AMD. Congress has to levy those taxes. Trump can't do it, right? And this isn't a tariff. This is like an export tax. But Congress can't even tax exports even if it wanted to. If you look at Article 1, Section 9 of the U.S. Constitution, which is where the U.S. government derives its taxing powers, Congress has the power to lay and collect taxes on duties, imports, excise. It doesn't have the authority to tax exports. It's not there. Remember, if the government isn't given the authority, it doesn't have the authority, right? The powers have to be expressly enumerated in the Constitution. And the founding fathers specifically left exports out. So the U.S. government can tax imports, which is a tariff, but they can't tax exports. Well, what they're doing here, what Trump is doing, is a backdoor tax on exports. Maybe he's saying, well, I'm selling an export license, which there's nothing in the Constitution that allows that either. The Congress or the president doesn't have the power to sell export licenses. But if the license is basically a share of the revenues, that looks like a tax, right? That's what a tax is. So all this is unconstitutional. I don't like the fact that Donald Trump is trying to basically micromanage the U.S. economy as if it was Trump Enterprises. In fact, that's what he's doing when he's turning the White House into Mar-a-Lago. You know, he's got those umbrellas now too on what used to be, the garden area, and he's now turning it into Mar-a-Lago. And he's got all this gold leaf and everything now all over the Oval Office, right? He's running America like it's, a Trump enterprise.
Silver's rally is getting another tailwind, this time from HSBC. The bank just raised its price targets for 2025 through 2027, pointing to high gold prices and safe haven demand in a world still rattled by geopolitical and economic shocks. But they're quick to note this surge is more about silver's gravitational link to record-breaking gold than about its own fundamentals. Gold has climbed 29% this year, smashing through $3,500 in April as the US and China dug into a full-blown trade war. That safe haven rush is pulling silver higher, even as industrial demand looks set to dip slightly after 4 years of record growth. HSBC expects that lull to be short-lived, with a rebound by 2026 led by photovoltaics and electronics. Not all demand drivers are firing. Jewelry and silverware buying is likely to keep slipping under the weight of high prices, while coins and bars have lost momentum after earlier buying sprees. Institutional interest in precious metals is showing signs of shifting into a higher gear. Gold's steady climb is being matched, and in some cases outpaced, by silver's sharp moves, fueled by both macroeconomic pressures and renewed investor appetite. The recent push in mining stocks, with GDX nearing a record high, hints at a broader reallocation of capital into the sector. At the same time, central bank steady retreat from the US dollar underscores a structural change in global finance that could keep both gold and silver in demand for years. Even with pockets of weakness in areas like jewelry and retail investment, strategic buying from major players, combined with silver's tight link to gold's trajectory, is setting the stage for potentially explosive moves ahead. If silver clears the psychological barrier at $40 and gold continues its upward march, will this be remembered as the early phase of a historic run in precious metals, or the moment the market finally outran its fundamentals? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.